Guys, I want to start with an exercise instead. And you can see here, let me be blunt to the changes I've done. You don't know what chart this is, number one. And you also don't know the time frame. I put the time frame as of now, but it's really not. And the question to you is, would you buy this chart? Would you sell this chart? It's such an important exercise because looking at this, it just seems like there's structurally a problem with this security, whatever this is. And the matter of fact is that what if I tell you this was one of the best setups for an opportunity ever potentially in terms of this asset class? This was down, way over double digits, or I shouldn't say triple digits, but like high double digits. And still, imagine trying to defend your thesis, looking at this chart and telling an institution or institutional client, or even if you're a central banker, and trying to make the point of why you should be buying this asset. Now, let's see the next chart. The next slide tells you, reviews what this is. This was gold from 1981 to 2001. The security was down, or gold was down 70% during that time. If we go to the next chart, we can see the subsequent period from 2001 to 2024. And you can see here, this was by far one of the best times we've seen to invest in gold. I just think this puts into perspective what we're seeing in a lot of the securities that we've been investing in this space. If we go to the next chart, would you then buy this chart? This is actually the time frame I'm showing you is true, meaning this is as of now. We've been seeing a downward movement in this chart since 1995 all the way to 2024. People have lost faith in this chart. People think this is a chronic problem with this, should I say, industry, or is it not an industry anymore just because it's so beat up? Liquidity is gone. Nobody invests in the space. We don't even have professionals that want to come in and work in this space. I think you know what I'm talking about, but let's go to the next chart. What I'm referring to is the miners to gold ratio. A lot of people think that the miners will never outperform gold because it just hasn't for the last 20 years. I just showed you a chart in which it showed the exactly same time frame of about 20 years of a security that has gone nowhere but down throughout that whole period. I don't remember a time in history that gold has been down 70%. So just to give you a sense of how much of an extreme of a movement we saw during that time. A lot of people had the faith that gold would have done well during that period because it was, we had the break of the gold standard, and then gold did really well in the 70s. Imagine being caught up into that whole narrative in the 80s and losing 70% of your money if you invest just in gold all the way from to 2001. This reminds me of today in this mining space. And in my view, there is a multitude of technical setups in this industry right now that I cannot recall personally a time that I've seen that. At the same time, most people were just ignoring, neglecting, and just choosing to look away. And to be honest, if you want to be bullish in gold, and I feel like I just hear crickets. I mean, there's really not a lot of folks still defending this industry. Even if we go to conferences and we speak with other folks in our own realm of professionals, we can clearly see that the narrative not only has shifted over the general investors, but now clearly as well within the industry too. And to me, this is the same setup we saw with gold. It's what we're seeing today. And would it surprise you if we see something like we saw with gold from 2001 to 2024? It wouldn't surprise me. I actually think that that's a very likely scenario, and probably how things will unfold in this coming decade. Let's go to the next chart. let me give you a sense. This is just throwing a line on top of this chart. If you're a technical analyst, you would appreciate the fact that since 2015, this chart has gone sideways, as you can see in this chart. And recently, when I mean recently, I mean this week, we've actually started to break out in this ratio. And I should actually give you the calculation. It's just looking at the Philadelphia gold and silver index, which everyone has access to. And I'm dividing by gold prices. So my apologies for not having, I usually have the calculation of the ratio there just to help you understand what I'm doing. But clearly you can see that not a lot of people think that the miners, the gold companies, first will follow gold prices. And number two, that they actually maybe could have leverage over gold's performance. This has been sort of unusually difficult to support the thesis that if we see a gold bull market, we would see this breaking out. That's my view, but majority of people would disagree with me just because in the last 20 years, we didn't see that. That's just such a wrong way, in my view, of seeing this, because I just showed you a chart of gold in which we saw the complete opposite 20 years after hitting that bottom. To me, this is like a perfect technical setup. Now, let's go through that multitude of technical breakouts that we're seeing in the mining industry. Let's go to the first one. This is one, junior miners. So we were looking at the bigger miners. Now we're looking at the smaller miners. Here is a 14-year downward trend, started in 2011. This was when gold peaked at that time as well. And now we're above those levels. But the miners are so far still from those periods, although they're making money as basically generating as much cash flow as they were back in those days. They look a lot healthier. But for some reason, people want to, support the idea that fundamentally they shouldn't be justifying allocation of a portfolio into the space. But if we look at the riskiest part of this market, the junior miners, in which, by the way, the companies we talk about in this presentation even don't even have the luxury of being at the GDXJ. To somewhat benefit from a little more liquidity than other vehicles. And you can see here that even in that sense, we just broke out from a 14-year downward trend. And looking at the prior chart and now this chart, it gives me the belief that maybe this is the beginning of something. But maybe let me try to convince my argument over this next following charts. Let's go to the next one here. So the next one now is looking at candles. We're doing monthly candles of the GDX. So now it's not a ratio. It's just looking at the actual performance on a monthly basis by candles of the GDX, which a lot of people would argue this is more of the senior part of the industry. Senior meaning those are companies that have already generate either production and mostly actually have cash flows. You can value these companies very different in the junior space because you can discount the cash flows of those companies, and instead of the way dealing with exploration companies that work a little bit different in terms of how we value those. But you can see clearly that even from that basis, the same chart of 2011, that peak that we saw, and you can see here 2010, 2011, we kind of stay at that peak for a while. And that really formed that beginning of the resistance. Then we had a massive crash all the way to 2015. And then we finally hit a bottom there. And we started to form higher lows, as you can see in this chart. So the first low was in 2018. And then we had the COVID lows. And then we had in 2022 another low. Recently, this year, actually, we had another higher low in 2024. And then we broke out. And now for the first time on a monthly basis, this is the first candle, and this is the beginning of the month. We're July 12th today. This is the first candle that if the month was ending today, we would be breaking out from this chart. That's something to be aware of. Let's go to the next chart now. The next chart now is showing just a GDXJ. Again, no, we're not doing a ratio anymore. We're just looking at the GDXJ now. The GDXJ, for those who don't know, the J is just means juniors. Although there are some senior or bigger companies as part of this this ETF, we do have smaller companies relative to the GDX, so they carry a little bit larger risk. And even from that basis, as you can see here in this chart, clearly this is even better than the prior chart. This is, to me, even more evident that this is a real breakout. So you can see here, the line has touched this resistance multiple times, not once, multiple times, particularly since the COVID first upward movement we had, that we hit that resistance, formed that kind of solidified this downward trend. And then now we've been also forming higher lows. And finally, we had a breakout 3 months ago, and we're solidifying this movement now for the third candle, as you can see in this chart, which appears to be the beginning of a much bigger move, in the initial phases of a much bigger move. Let's go to the next chart now. Now, let me show you another one, silver, because this idea that we are potentially in the bull market for gold, first thing that comes to my mind is silver, obviously, because if you are of the view that this is a long-term cycle for the metal, it's just hard to believe that we won't see silver also taking the lead on performance basis. And we've seen this in the past, and a lot of people are skeptical about this chart because of the frustration of the metal not moving for so many years. As you can see, there's been a very long consolidation, and it explains as well the skepticism in the mining industry too, because silver and the miners are not too far. Well, although we did see gold break out first, silver is doing, as we speak, is doing something which appears to be very special. And the third one now, it's been the miners, the gold and silver miners, the copper miners are starting to move as well in a substantial way. And in my view, this is really just the beginning. I mean, the money is flowing, and that funnel of capital is flowing down the industry. It's coming in. It's definitely streaming down to the smaller companies, and eventually, that's what creates an M&A cycle. That's what creates a speculation in this industry. That's what creates liquidity for those who have been investing and accumulating shares of cheap, high quality exploration assets. Ultimately, that's what this all, in my view, will translate into. Let's go to the next chart now. The next chart now is showing a little bit of a different thing. Everything has been sort of breaking out. Now, let me show you a breakdown of a chart, which still is extremely bullish for those who like to invest in precious metals. I've shown this chart about gold to silver ratio. And the importance of this chart as well is that historically, this is one of the highest levels we've seen of this ratio in history. We broke out of a 13-year support, as you can see there, which was very significant. And then recently, we actually went all the way up and retested that line. A lot of people came out and said, the silver is due for a major correction and all sorts of things that we heard. And guess what? We're starting to move all the way in the direction of this ratio once again. And in my view, this is the beginning of a movement, not the end of one, just like the prior charts that I showed. And I think they're all aligned. It's not, in my view, it's not a coincidence. It's really, it's actually a setup. And so for those that have the conviction to stick with the plan, stick with the idea, stick with the thesis, I think are going to be the ones really taking advantage of this macro scenario. Let's go to the next chart. Silver demand, I think was William from Discovery Fund posted this chart of Bank of America showing silver demand for solar panels. And I think this chart is valid and really interesting. But you know what I thought was really fascinating is the fact that the demand for solar panels, you can see back there in from 2016 to 2022, this chart has kind of gone sideways. And then we have a jump in estimates now, and actually the first bar that is a big jump is 2023, as you can see there. But then the estimate of 2024 is also another jump, and it keeps jumping from estimate to estimates. But if we just assume 2023 as our base for all this and so forth, it's fascinating that it's close to 20% of, if you take the total supply, how much we're producing of silver on an annual basis, and we take how much of this has been used on as a demand for solar panels, it's about 20% of that. And if we go back to not too long ago at that period that was basically stagnant, it was below, it was below 7% actually. So you can kind of see the exponential growth, and who knows if these estimates are accurate. Potentially they could be understating the growth that we could see in silver as well. This is not even to say the monetary aspect of owning silver in a gold bull market potentially, and the benefit of that in terms of performance. And so this chart is interesting from another alternative of demand that is certainly becoming stronger of an aspect for silver as well. But I think there's a lot of other things as well. So let's go to the next chart. So, I spoke this the other day, and I do think this is this a little bit shocking. I think it requires a lot more research than saying the technological advancements have allowed the mining industry to not really have to spend a lot of money and not use a lot of labor. I think there has been some of that. The argument can be used as efficiency reduces capital, the capital intensiveness, and also the number of people that need to work in a mining company. But this chart basically is looking at something called private fixed investment, which is when you have a GDP. That's one of the calculations you use, is to look at fixed investments from privately, not from the government. And those are usually fixed investments, are investments over the long term and so forth. And you can see, you can break it down just mining as a percentage of overall GDP. And mining used to make up close to 17% of this economy back in the 60s. And you can, even in the 70s or 80s, it was about 10% of GDP. Today, it's at 0.3%. Now, this to me speaks volumes to the opportunity, the fact that I think there's further explanations on this, and maybe even Quentin should comment in his segment about this too, because I think I would love to get his take on it. But I think this has a lot to do with globalization too. The fact that we've been running away from a highly globalized environment that we've had all the way from the 70s, 60s, particularly from the 90s to today. And as we see those things changing, it's just hard to believe we're going to continue to just import metals. And we're actually going to probably see this as a critical industry. It's crazy to think that we think of AI and other things as critical, but not the actual materials that allow us to advance those technologies. And so to me, it's just a matter of time for us to really start seeing the overall industry of mining again being seen as a critical part of the economy. And so this 0.3%, it just comes to my mind. Well, what if we just double that? How much money is that going to be flowing into this industry? But honestly, I think we could see a lot more. It's another one of those charts that reminds me of the gold chart going back to 20 years, that we just see an industry that basically lost interest from investors for a secular basis. And this is basically what's happening here. Technology has taken such a form of the global economy, but really the US. And I think we've swung too far in that direction, and potentially capital needs to flow back in order to have a civilization. I mean, I don't think we can survive in a deglobalized environment and continuing to ignore this industry as a critical element of society. Let's go to the next chart. And so what is a macro shift? A macro shift as well is seen in this commodity prices. And it's interesting to me that this is not just one part of those changes. I mean, we've seen so many things change since the COVID. Commodities have broke out since the policymakers' response towards the recession in the lockdowns and the pandemic period. We've had a fiscal stimulus to the wazoo. We've had interest rate cuts. We saw all sorts of measurements. Inflation Act being passed. We saw an infrastructure act. We saw a war breaking out. We've had things like the Japanese yen collapse and used to be the safest currency in the planet, we started to see value companies, not growth, starting to do better. We started to see some emerging markets doing better. Those are all important changes. We've saw volatility in the treasury market. When was the last time we saw this type of volatility in the treasury market? Maybe just in the 70s we would be able to use that as a period. And so all these things are certainly I think impacting these macro regime shift that I believe we're in. And if you look at this chart right there, after this breakout that we've had in commodity prices, an equal weighted index, we've been consolidating for a while now. And this is why I tend to not, overly focus on the CPI number and all these things that come in on a monthly basis, because I do think inflation is incredibly entrenched in the U.S. economy and other developed places. And this chart is another way of seeing this. Let's go to the next chart. Next one is showing another way of seeing this regime changes on the 2-year yield. The 2-year yield, all the way back to the 80s, really, every time we bump into this resistance, recession. So double dip recession started over there. And then we had the tech bubble, major recession there as well as we hit this line. And then we saw the housing bubble. And basically, this is sort of a response towards leverage, right? Because yields are falling and debt is increasing. That's basically what was going on. A higher manipulation from central banks, or I should say higher intervention from central banks in markets from different vehicles. And if we think about how much has policy making changed since just the global financial crisis has been really, I think, instrumental to see the suppression of volatility and all sorts of things that we've had over the years. But since then, we actually broke out from this resistance finally, which to me, that just means inflation. We're in a different era now. And it wouldn't surprise me, even myself was in the inflation camp over the next 5 to 10 years. I look at this chart and I see people going from 7 price interest rate cuts in the curve all the way to 2, and people really have disbelief that we could see yields moving lower. The same folks that said there's no way the Federal Reserve could raise interest rates all the way to 5.5% are now saying that the Fed cannot reduce rates because of inflation. And in my view, while again I am of the inflation view, I do think that ultimately what matters is going to be the cost of the debt for the government. And that's the main role of the Federal Reserve. And we'll be emerging into that role over time, just like it did in the 40s because of the extreme amount of government debt to GDP. And I think this is going to be the case here as well. And very likely, it wouldn't surprise me at all if we see this chart retesting the 2% level, which would be forming now, instead of a resistance, would be creating a support at that what used to be a resistance line. Let's go to the next chart. The next chart shows a chart from Increment and AG. Ronnie Serfole actually has been sharing this chart, and I think it's a phenomenal chart. It gives you some sense of that we could see stupid gold prices in this environment. The idea really is just looking at Fed funds rate. When the Fed starts to cut interest rates, they get into an economic problem, and it forces the hands of central banks to reduce and cut interest rates. While a lot of people see that as a spurt of potential growth given the liquidity, that's not usually what happens. Those more recent takes that we're hearing that interest rates cuts are positive for equity markets, it's really not my view either. So, but you can see that the performance of a hard asset, the performance of gold as a not only an alternative but really a defensive asset is second to none, and it's just outstanding. And it wouldn't shock me at all if we see much higher prices that actually are similar to those growth rates that we've had in the past. And, you can throw estimates of a median of the 31, 39, and 5% growth. And we could see, some real impact in fundamentals of mining companies if we see prices substantially growing from here. Let's go to the next chart. Lastly, going back to a little bit of the yield idea and analysis on yields, you can see here, I think one of the most important developments happening today is this been the last, I guess, this whole week, it's been the steepening of the yield curve. The steepening of the yield curve is something that a lot of people also thought it wasn't possible to see. Maybe, I love when people start saying this is maybe this is a new normal, that we're going to see just inverted levels for much longer than usual. Folks, we've been inverted for the longest period in history. This is the time to be betting the other way, in my view. And so what we're seeing in this chart is that is the 2-year versus the 3rd-year yield. We can see here that I sort of had it's saying there the arrow showing the steepening phase. But what is more important about this is that we're seeing sort of some parts of the market move in one direction, showing that interest rates are supposed to be higher for longer. We're probably going to see profitability becoming more and more of a more and more of a prioritization towards investors, that we should be perhaps looking at commodities again, that we are seeing a gold rush of central banks accumulating the metal, and all sorts of things that are happening, the deglobalization trends, populism, the inequality problem. And then people come up and say, well, we're probably, these are all, maybe real trends in the future, but VIX and volatility and financial stress should be suppressed historically. And I'm not of that view at all. I think that there's a lagging effect of overall cost of capital rising into volatility. And I think the clock is ticking faster. And I think we're getting really close to a change in volatility profile here in equity markets in the US. And so this is just to show you a few of the other times when we had steepening of the yield curve. And the steepening of the yield curve is one classic recession signal. And a lot of people are dismissing this. And I have one word for it: complacency. I think that's the word to describe what's happening with the expectation of financial stress and volatility staying lower for longer. That is not my view at all. Let's go to the next chart. I'm almost done. You can see here another way to look at this that I think it's a very interesting way is certainly the real Fed funds rate versus the S&P 500 earnings yield. And you can see that this difference between the two. So the red line is basically saying how expensive is the equity market. And essentially every time the red line falls, the markets either get really expensive or earnings have been completely crushed. It's one of the two. Majority of the times outside of the global financial crisis, the reason why the red line is falling has to do with the fact that equity markets are too expensive to how much money those companies make. That's essentially what the red line is showing you. The white line is showing something different. It's showing the cost of capital. And it's one way of measuring cost of capital. Of course, cost of capital, you should also look at equity, risk, and other things. But this is looking at debt, essentially looking at Fed funds rate relative to CPI. And you can see that we're above CPI on the Fed funds rate, basically double the amount of Fed funds rate today, of CPI rate. And the only other time we've seen this was either at the very peak of the market in the housing bubble, or back in the tech bubble peak as well, in which, as you can see, the earnings yield and the real rate of the short-term Fed funds rate here was, basically eclipse that line. And so right now we're not too far from that. So I'll definitely consider this chart as another way of a parameter for risk. Let's go to the next chart. I think I'm almost done. And another thing you should look at is the timing, the lagging effects of interest rates into the economy. And this chart is great because it shows that bankruptcy filings are starting to pick up. This is the largest monthly change since the COVID crisis. And you can see here, this is starting to show some signs of an upward trajectory. And if that's the case, that's when you start seeing big downturns in the economic data. Not only that, you could potentially see the 2-year yield going back to 2%. This is the case that you could see that 2-year yield going back to its what used to be resistance. Now it's going to become, in my view, support. Let's go to the next chart, because if you dive into this, you're going to see that consumer discretionary is the largest sector actually filing for bankruptcy, which begs the question, why? And the answer for that is because consumer discretionary has never been this levered. Since the COVID recession, most of consumer discretionary sector and companies have really levered up. And that's why we're seeing the rolling of that debt at higher interest rates is causing some of these companies to go out of business. Let's go to the next chart. I'm almost done, promise. Last one is Quinton made a comment about the Dow Jones in gold terms. I thought this was a good chart to be created. So I looked at historically Dow Jones just because it has longer history. It's not because I picked Dow Jones. You can see the S&P 500 will show similar signs, but it's remarkable that we're basically trading in the same levels we were back in 1929 at the very peak. The difference is that recently we've had a justification perhaps for running into extreme multiples in equity markets. And that justification potentially could have been that we were in a NERP environment or a near zero interest rate environment. That is not where we are today anymore. We're at 5+% interest rates. Most corporations can't even borrow money at that rate. They have to borrow money at least at double that amount. And so, I would suspect that the risk and the fact that people are just overlooking this chart and saying, it's a different environment. It's not anymore. We're back to the game where interest rates do matter, and we're going to start seeing changes of how we value companies over time as well. So profitability, I would stick with that view. Profitability will start mattering again, and I don't think we're too far from that either.